Good afternoon, it's Paul Scott here on Thursday the 4th of June 2015 with my usual now, only been doing them a few days, supplementary report following on from the written small cap value report. So with the written report today I looked at two quite big profit warnings from Pressure Technologies down at 29%, and Sysys, a software company, down a similar amount. Also results from Vianet and very good results from Equipment Hire Group VP. So that's the written report. What am I going to talk about today in this report? Well, quite a big sell-off in the FTSE today. I noticed it was down over 100 points earlier. It's quite interesting that spilled over into smaller caps shortly afterwards, not first thing necessarily. I think it's quite interesting, I think, on a sharp down day to look at which stocks in your portfolio are experiencing the selling pressure, because those tend to be the more speculative ones. I really like it when stocks I hold don't drop at all on a FTSE sell-off, and that's happened with quite a few things today. One of my favourite stocks, Avesco, has even gone up slightly. A couple of others have as well. So I think it's always good when stocks I like go up on a down day. Anyway, let's get into the meat of it. First of all, I'm going to touch on plus 500 again. A friend on Twitter pointed me towards this article in Shares Mag, where Crispin Odey's fund, which now has 25% of plus 500, is basically saying they're going to reject the £4 cash bid. I think, I just don't believe that, basically. I think management have recommended the bid at £4, and management know the company a hell of a lot better than any other people do. So if they're happy to take the £4 and run, then that says to me that business is probably worth less than £4. So this, to my mind, is posturing from a fund that did incredibly badly. If you look at this article here, they made a 19% drop in April, which is staggering for a $2.3 billion fund. So I think to a certain extent maybe these are people who are sort of thrashing around desperately looking for quick wins, having really balls things up. Seems to be currency speculations and various other things. Also, I mean, they've gone into a buying frenzy on tungsten as well, which has proven to be completely the wrong thing to do. I think maybe they got lucky with plus 500 rather than much skill being involved there. So anyway, I'm still sort of circling plus 500 with a view to opening a new short position on it, because I think there's a good chance the bid will fall through, and I think there's limited to very, very low chance of a higher bid. Anyway, I'm sure that will continue to keep us entertained. Now, looking next at OncoWotsits, Advanced Oncotherapy, which I touched on yesterday. Very interesting director dealing statement today. The executive chairman purchased an option over 30 million ordinary shares at for £300,000. Now that's very unusual, to actually buy an option at a penny a share. He's paid for that, basically, and now the exercise price is 10p per share. They're about 9.25 as I speak. So the chairman wants the upside well above 11p a share, because his break-even point would be 11p, and this is a 2-year option. Now that says to me that this guy, I mean, I don't know who he is or how well heeled he is, but it's a fairly decent sized punt on there being some serious upside in this share over 2 years. So I think that's interesting. Very speculative. The market cap is very high on this. I totally get the bear case on it, but actually I think there's some quite interesting potential at that company, having seen a presentation document about what they do and the margins they expect and all the rest of it. Trinity Mirror phone hacking. Now this is a very interesting one, because I've been banging on about this for literally years. I've always said Trinity Mirror were up to their necks in phone hacking, and the reason for that was because you can read about it on the internet. It's been in the public domain for several years, but bizarrely the stock market has totally ignored this risk for several years. Well, it's not now. Look at what's happening to the share price. Today's statement says that the company, there have been some assessment for damages in civil trials where the judge has awarded them a lot more than they think is fair. So, I think they're potentially in trouble with this. I really do. So I should have shorted it, because a friend told me that this was all blowing up again when they were about £1.80. but it slipped my mind, unfortunately. So yeah, very interesting one, that one. Now, AudioBoom, interesting little speculative company. They've come out with one of these KPI announcements saying how great everything is. These blimmin' adverts are such a nuisance. Right, the number of registered users has gone up to over 4 million at the end of May, 600,000. I mean, all the stats look great, but just bear in mind with these types of stocks that the financial figures when they come out are an absolute joke. I mean, turnover is virtually negligible. You know, my hairdresser takes more in annual turnover than AudioBoom does. Market value is 38 million. They've got, what's that, about 8 or 9 million cash in the bank from the placing last year. Turnover last year was 50k. So a forecast rise to 3 million this year and 7 million turnover. I don't think they'll get anywhere near that. But it's a very speculative. I think these KPI type announcements are dangerous because they lull you into a sense that this is a big success story. The reality is, in financial terms, they've got a mountain to climb to get anywhere near break even. It's a nice little app though, but difficult to see how they'll make a viable business out of it. Alright, what else have we got? Wincanton. Now this has got to be the worst balance sheet on the market. Mind you, I haven't looked at Thomas Cook recently. That might be worse. Now, headline figures here, this is for the year ended 31st of March. Headline figures don't look too bad. Underlying profit, operating profit's up slightly. Note the big drop between operating profit and profit before tax. So about a third of operating profit goes on interest charges because they've got a lot of net debt. It says they're 57.6 million net debt, which doesn't sound too bad given the size of the company, but if you look down to their credit, they do actually say here that average net debt throughout the year was 136 million, which of course is well over double the year-end net debt figure. And that's an important point in that balance sheets only show the figures on a snapshot on one day out of the year. And most, if not all, companies window dress their balance sheets. And there's no rules against that. It's perfectly valid to present numbers on your balance sheet which may not even remotely match the figures for the bulk of the rest of the year. You want to show your best balance sheet so you get your cash figure as high as you can, or your debt figure down as low as you can on the year-end date. So it really has substantially more net debt than is shown in that net debt figure. But let's quickly scroll down to the ignore all this blurb. Let's scroll down to the balance sheet, because this is really a car crash. You've got 97 million there of intangibles, so just write that off. That doesn't have any sort of resale value. Now the working capital position, you've got 246.8 million net cash. Net current assets, including 105 million of cash. But look, you've got 379 million current liabilities, and this trade payables item is absolutely enormous. Trade payables should be less than trade receivables, but it's not. It's dramatically higher. Now that says to me that this company is really stretching its creditors and probably receiving a lot of cash up front from its customers, because the double entry for that would be debit cash, which goes here, and credit deferred income, which goes in here. So now that's fine if you can keep that favourable working capital profile going forever, but if the business were to cease trading, all these items here have to be paid out. All these items here are cash or turn into cash. So at a theoretical shutdown point, you would have a shortfall of 132 million. So you wouldn't be able to pay all your creditors, basically, if it theoretically ceased trading. That's just part of the picture. That's working capital. But look at the long-term creditors as well. 128 million of debt there. Again, 105 million cash. If those two netted off that way all year round, they would just pay off the debt. So really looking at gross debt is important, because that will tell you what typically the borrowings need to be. And this figure here will be a snapshot, heavily inflated for the year end. Employee benefits, a big pension deficit there. Provisions there, which is a mixture of provisions on property and insurance claims. Again, creditors are all things that will be cash going out of the business. or nearly always, in some shape or form in the future. And that means that's money that shareholders can't receive in dividends. Now, of course, this thing doesn't pay a dividend. I can't see how they can realistically pay dividends at all for the foreseeable future. Net liabilities, 261.7 million net liabilities. That's an insolvent balance sheet. There's no other way of putting it. And if you take off the intangibles, you're well over 300 million net liabilities. It's a really, really, really bad balance sheet. So I wouldn't go near it. There's an interesting table up here. This shows you the cash flows. So there's your operating profit and your depreciation added back. So EBITDA 64 million, but look where it goes. 9.7 million capex. You're going to have quite a bit of maintenance capex in this type of, it's a logistics business. Net financing costs 12.7. Look at the pension deficit recovery payment, 14.4 million, 14.1 the prior year. Onerous lease provisions, which are paid out in cash, were quite heavy, although they do say that's expected to reduce in future. And then this year there was a negative working capital movement as well. So the total sort of free cash flow there was negligible, 7.3 million this year. So I don't see how they're really going to make much of a dent into their overall debt. I think at some point a big placing here is inevitable. That's exactly what happened with Johnston Press, where I was making the same sort of points a few years ago. It's not a good thing to get involved with in my view. Let's have a quick look at the share price. It did drop quite sharply, but then came back up. It's rebounded to £1.70. You see, people look at it and think, oh, it's a PE of 9.2, what a bargain. That's what the Stockopedia computers think as well. But actually, when you drill into it, that's a great one to look at. If you have a not applicable there on price to tangible book, that means it has negative net tangible assets. That's a red flag in itself. No dividend yield, not likely to be any dividends for a long while. Look, the last dividend was in whenever that was, 2011. Can it get back to paying those sorts of dividends? I mean, if the bank manager remains accommodative, and the banks seem to be comfortable with that. I cannot understand why, but they are. So maybe I'm missing something. But for me, it dismally fails all my balance sheet tests. So I wouldn't go near it. What else have we got? I think that's more or less it. Oh, just on ZPLA as well, there's quite an interesting one. I'm short there, and the MONY supermarket put out, is that the Meerkats or is that something else? MONY supermarket. No, it's comparethemarket.com. Zippers, isn't it? What did MONY supermarket do? Oh, was that bloody annoying opera singer? I think it was. Anyway, this is interesting. They've been served with a Section 26 notice by Ofgem. MONY supermarket have, I hasten to add, to provide information on an investigation on competition law. Now, this had a spillover impact on ZPLA, who have just completed, I think yesterday, on the purchase of Uswitch. Quite an interesting discussion on Alphaville today, where they came to the conclusion this was a bit of a knee-jerk reaction by the market, but it's something to keep in mind, I think. Just on Twitter as well, somebody emailed me today and said I'd blocked them. Could I unblock them? I must admit I am a little bit trigger happy with the block button on Twitter. So if I've blocked you unfairly and you want to be unblocked, just drop me an email. It's just that where I'm short of things, I get so much abuse from people that I just hit the block button first for a quieter life and ask questions later. Anyway, running out of time, so got a dash. Bye for now.